Welcome to the AWA Market Minute, breaking down financial, political, and economic events that impact today's retirees. Our investment committee performs hours of research and market analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring top industry experts who share insights on important topics so that our clients can gain understanding and peace of mind on their journey to and through retirement. And now your hosts, Chief Investment Officer Scott Hoxer and Founder and CEO Paul Coles.
Well, Scott, we're back at it again. Another month, another Market Minute.
Yeah, it's amazing how fast months go by. You know, we'll blink and it's time for another one. So time does indeed fly by, and it has been an eventful month, to say the least.
I think that may be why the time passes so quickly is when things are happening quick around you, you don't realize how fast the time is gone. So we dive into today's topic. We're going to talk a lot about market volatility and obviously touch on tariffs. And as always, we want to remain, in that neutral space where we talk about the economics and avoid the politics of it. Sometimes they get intertwined, and we do our best to not step on anything there.
Yeah.
I had an interesting conversation yesterday, Scott, that I thought I'd share that maybe leads into some of the things we want to discuss today. I was helping an individual log into an account, and his wife had saved a password on the web browser to her computer in order to log into this financial account. And the husband said, "Hey, that's a bad idea. Don't do that. That's not safe." And she kind of brushed it off and dismissed him and said, I think she may have even used the word fuddy-duddy, and said, "Hey, it's not that big a deal." And he said, "It's not safe." And a few minutes later, we were talking about establishing this new account with a financial institution. And I said, I do tend to agree that it's probably not a best practice to save passwords on web browsers. I would find a better way to do that. I said, it's not uncommon if you get hacked to have that be one of the first places the hacker looks to see if they can breach all of your passwords, anything that's been saved on your web browser. And that's usually an easier, entry point for them to kind of break into. I said, so I would recommend putting them elsewhere, not in a place that would be so readily available. And she said, that's a really good idea. I want to do that. And the husband threw his hands up in the air and said, I've been saying this for years and you've brushed me off. And this guy says it one time, and all of a sudden, he's the world's smartest man. And I said, don't feel terrible. I've been married for 20 years, and my wife still questions some of the wisdom of the things that I, do professionally. And he said, like what? And I said, even this current market sell-off, has caused my wife some level of anxiety. And she's questioned the wisdom of, do we want to be invested right now? Right? And are we going to lose the question she asked is, are we going to lose everything? Is it possible that we lose everything? And so I've had to explain to her, just kind of zoom out. What does that mean, lose everything? And what does it mean to have your money invested in real assets?
Yeah. I think there's an assumption sometimes that investing is a zero-sum game where there's, it's binary. You win or you lose, and there aren't, shades of gray in between. And we know that that's not the case.
Absolutely. And so there's actually this really good, slide that I've used that talks about how investing is not like gambling. So if we look at all the best, most prominent gambling games out there, the ones that we're familiar with, like blackjack or craps, best case scenario, you're looking at less than a 50-50 chance that you will actually win one of these games of chance. But when we look at the market and owning something, and this study showed, a measurement from 1901 to 2021, so we're talking about 120 years of data, there was never a single 15-year stretch, in any rolling 15 years, select any one of the data points, and 99.9% of the time, the market won.
Yeah. Yeah, I love it. And also on this chart, it shows 3 out of every 4 years on average, markets are up. I mean, that's a tremendous endeavor to enter into where, hey, I get to be right 75% of the time.
75% of the time.
Yeah.
So I explained this, to my wife. I said, think of it like we own a share of Home Depot, right? So Home Depot is an actual asset. They own a significant amount of real estate holdings. They have hundreds of millions of dollars in inventory in every store. And they sell a lot of product every single day to consumers. And if I own a piece of that, that's the asset that I am entitled to have a claim on. And so when markets are bad and valuations of things that we own change, do I actually stand the chance of just quote unquote losing everything? This isn't like some speculative investment. This isn't like an option strategy. This is an actual share of a real asset. So I explained it to her like that. And I said, what drives Home Depot are earnings. So if we look at this chart here, we can see that Home Depot's stock price consistently improves as Home Depot consistently sells more stuff. So there's like this intrinsic relationship between earnings and stock value. And you can actually see that the correlation is 96% correlation between their earnings and their stock value. And this is the chart of their earnings. And for the last 15 years, Home Depot's up almost 1,000%. So if I put $10,000 into Home Depot back in 2010, today it'd be worth nearly $110,000 15 years later. And it's not a game of chance. It's picking an asset that has real value, that sells really good product with demand that consumers will continue to go back to. They've run a good business, and as a result, the value of that asset has gone up.
Yeah, and I think this is something super important to understand as investors, Paul. When we see price movements in stocks, it is a response to the expected future earnings. So when stock prices move either up or down, it's because the expectation around earnings has changed, full stop.
Yeah, and that's a really good, I think, setup to what we're going to be talking about today as far as like, why is there so much new volatility, right? But to finish this thought, the correlation over the last 70 years with the S&P 500 earnings to value has been 97%, right? So 97% correlation to say we can really identify the value of these quality assets based on how much stuff they sell, right? And which is why we talk about America being this powerhouse economically, because we are a consumer-driven nation. We like to buy stuff. We like to spend our money. And as a result, these businesses that we have built have been highly successful because they continue to drive good earnings. So, Scott, let's use that as a launching pad into kind of today's conversation.
Yeah. So as everyone knows, we've had turbulent markets, and the genesis of a lot of that is it's been ongoing for several months now. But April 2nd was a turning point, and what happened on April 2nd is we had the tariff announcements by President Trump, and they were very different than maybe what the market had been expecting. The market was expecting some tariff; they weren't expecting global high levels of tariffs. The tariff rates that were announced were higher than anything we'd seen since the 1930s. So you had to go back 95 years to find tariff rates that high. And because of the surprise and because of the expected change in earnings, markets sold off pretty significantly. And you can see that on the chart here where April 2nd through April 8th, markets fell really precipitously. And if we look back, it was, if memory serves, the fourth biggest two-day sell-off that we've seen in the last 90 years. And so it was a breathtaking sell-off. And as things were selling off, the question arose in our minds, who's going to blink first? Are markets going to blink first, or is the administration going to blink first? And because of the price declines in the stock market, because of some of the turbulence we saw in the bond markets, which we'll get to here in a second, I wouldn't call it a U-turn certainly, but the administration did back off tariffs significantly for 90 days, and as a result, markets rallied pretty significantly.
So, just curious. I mean, I know we'll talk about this in a minute, but what do you feel like did trigger that? Was that triggered because the administration saw this market sell off and they thought, okay, we don't want to cause too much damage? Was it triggered? I mean, what we were told was all these nations lined up ready to do a deal, and so tariffs were working as a negotiating, form of diplomacy. Or did something else happen?
Yeah, it's tough to pinpoint exactly. I can share my thoughts based on the research and the study that I've done. But by all accounts, there's kind of two factions within the administration. One is very much in the camp of tariffs for tariff's sake and having long-term high tariffs as an economic strategy. There's another camp, it appears, within the administration that sees tariffs more as a temporary negotiating tool. And I think those two factions were kind of fighting for the president's ear. And the faction I think that is carrying the day right now is the one that sees tariffs as more of a negotiating tool. Yeah, and I think really what kind of got them over the hump was some significant turmoil that we saw in bond markets. We started to see U.S. Treasuries selling off to a high degree. And there's a market adage that the stock market's very smart, the bond market's even smarter. And bond markets offer visibility into how people are perceiving credit quality, how liquid and functional credit markets are. And in 2008, when the financial crisis occurred, bond markets locked up, credit markets locked up. And so when credit starts to appear distressed, that's where institutional investors, that's where policymakers really start to get panicked. And we were starting to see that around kind of April 8th.
And explain this to me again. So it's often said that this is kind of the plumbing of the financial system.
Yeah.
How does it work where another nation can dump U.S. Treasuries and that begins to slow the general financial system?
Yeah, so what happens is over the past several decades, we've incurred a lot of national debt, and we need to have buyers of that debt. We have domestic buyers of the debt. During COVID, the U.S. government was a buyer of its own debt, which is an interesting concept. The Federal Reserve was buying U.S. Treasury debt. But sovereign actors like China, the European Union, and others buy huge quantities of U.S. debt. And so when they sell that debt, that pushes interest rates higher. Bonds and interest rates have an inverse relationship. So when they sell that debt, interest rates go up, and higher interest rates slow down the overall economy. Lower interest rates are consistent with easy money and a lot of liquidity in the system. High interest rates do the exact opposite.
Okay, so by selling that debt, they raise interest rates, and the number that had raised was something like 60 basis points over a 2 or 3 day sell-off.
Yeah, it was the fastest rise we've seen since 2001. So it was a once in a kind of 24-year event as far as that rapid increase in bond prices. And I think, the Treasury Secretary and others were very much banging the drum of, hey, we probably need to hit the pause button here because we're creating some unintended consequences.
And what was interesting is, you'd grabbed our investment team as this was happening and said, we need to be watching this closely. Like this was something that was, somewhat cautionary, not somewhat, it was very cautionary and very, something that we had to watch closely. But simultaneous to that, I don't think there was a lot of news or coverage regarding it.
No, not a lot. You had to kind of, I call them page 13 items where it's not on the, and this is going back to the days of paper newspapers, but page 1 has the headlines, page 13 has the stuff that oftentimes matters more than the stuff that's on page 1.
Last month, Scott, you threw out the term blue light special.
Yes.
Which, harkened back to the old Kmart days of putting something on layaway. And this month you're throwing out page 13.
Yeah.
So all of our boomer clients are really appreciating the throwback.
Yeah.
The nod.
Yeah. Yeah. Not to be, too personal or whatever, but I miss the days when I could spread out the Wall Street Journal on the floor and look at charts and everything. So I'm an old soul, Paul.
That is very,
Yeah.
very true. So as we keep this conversation going, there's another part to this story. What are we looking at on this slide here?
Yeah, so this just underscores the point that we'd been talking about as far as the rapid rise in interest rates. And so you can see, just for example, the purple line at the top there, you can see kind of the trough in the center of the screen, and then that rapid rise. That rapid rise is what really spooked policymakers, and in my opinion, a pretty big driver of the pivot on tariff policy.
Yeah, yeah, and any possibility that this was other nations doing this intentionally then?
Yeah. Very, very much so. Because I think, I hope it's not lost on anyone that we're not out of the woods yet. While kind of the global nature of the trade war has been muted somewhat, we'll see kind of how that actually shakes out. We are still in a full-fledged trade war with China, and they carry a lot of our debt, and so we're not necessarily out of the woods at this juncture.
Yeah, the analogy that I've been using is we're in the middle, kind of that eye of the storm, so to speak. We've things could have been much worse 2 weeks ago had we not put a pause.
Yeah.
Right. We got kind of through that really rocky terrain. Things have seemingly calmed a little bit. Obviously, markets are still responding, and some of that is not as much about the fear and uncertainty as it is there's actual real implications now.
Yeah.
Right. I mean, NVIDIA yesterday, we'll talk about that as well. But there's still more up ahead of us. We need to definitely be mindful of the fact that this is not over.
Correct. Yeah, and we have seen credit markets stabilize, and so that's been a very encouraging sign to see stabilization there. But equity prices are trying to find their footing. They're saying, hey, this is a brave new world, and we're trying to adjust on the fly to some of these things. And as earnings expectations get more and more dialed in, we'll see this market get their footing. But right now, it's trying to process, how does this impact companies' cash flows? How does this impact supply chains? And that's what markets are trying to digest right now.
So in this next slide, what are we seeing here?
Yeah, so I thought this would be a good one to, for you and I to have a discussion around, Paul. So this is the price of Apple stock. So after the tariff announcements, Apple fell 23% in about a 5-day period of time. So just fell like a rock. And to kind of harken back to your Home Depot example, was Apple all of a sudden worth 23%? Was one of the most valuable companies in the world worth 23% less with one announcement? Maybe, but probably not. Markets have a tendency to sell first and ask questions later. And so what we will often see is visceral kind of overreacting selling, and then as new data is received, we'll see prices kind of find their footing. But I think when we see kind of that selling and it becomes kind of irrational in nature in some cases, know that that's kind of a temporary thing, and that markets will find their footing. The other interesting thing, not to get too nuanced with this, with that particular buying rally that we saw something called a short squeeze. I don't know that we've ever talked about that with our clients. One of the reasons the market rose so significantly on the back of the huge sell-off, a lot of investors were short the market, meaning they were betting on the market going down in value. And when that surprise announcement came that the administration was reversing course, they had to close out their short positions. So you had far more buyers than you did sellers, and that pushed the prices up. That's why the day after the buying, we actually saw a pretty significant sell-off, because that was more representative of where people's heads were at.
Yeah. It's a little bit manipulated at the end of the day. And to your point a moment ago, did Apple's value actually change by 25%? I mean, that's years worth of decline, and it happened in a period of days. And the answer is that's not a really feasible, logical conclusion. The market tends to sell first, ask questions later, right? Kind of come up with answers to these problems after the fact. and when Apple is producing whatever percent of their iPhones in China, and we, you know, have these full-fledged trade war with China. I mean, 150% tariff threats going on right now. Apple saying, how on earth are we going to fulfill this demand with this price hike? Are we going to rebuild manufacturing somewhere else? How would we do that overnight? I mean, supply chains take years to establish and create factories, and to pull all the rug out from underneath us overnight would be impossible. So consumers say, great, then we're going to sell Apple for a minute and let them settle that problem. And as a result, Apple has this significant valuation shift.
Yeah, yeah. And you're seeing, particularly these large companies with a lot of resources, you're seeing that they're adjusting as needed. They have deep pockets. They have a lot of cash on hand. They have a lot of resources to respond. It might not be as optimal as what they had previously, but that's the beauty of kind of, you know, capitalism and our market-based economy is these companies can be fairly nimble and they can adjust on the fly. To be clear, it takes years to build supply chains, but they have the resources to make the necessary adjustments.
Talk to us about NVIDIA. So yesterday we saw a significant sell-off there, obviously related to tariffs, but there seemed to be more substance to that, not just fear. What was going on there?
Yeah, this was like a real-life example of kind of the rubber meeting the road. And so they took a $5.5 billion charge on, and I think they labeled it as an inventory charge. And the idea was, hey, this is inventory that under tariff or other rules, we're not necessarily able to export any longer. And because we're going to have to sit on this inventory, we have to take a charge on it. And so markets obviously didn't like that. You know, that's disruptive to their business model, and markets responded accordingly with some NVIDIA selling.
So this is always interesting. You know, we talk about the market trying to find the correct pricing, and so we look at tariffs and say, okay, this is triggering this inability to put our finger on a price of something. We can't forecast it correctly. It's hard. The market's like predictability, and this is the opposite of that. But all of a sudden we see a real application that's not just a fear-based thing. It's an actual, this is a pricing problem. And, you know, I had an interesting email just this morning. You guys always tease me because I love pickleball. And I jokingly say all things in life relate to pickleball. But the email this morning was from a pickleball manufacturer of paddles. And, you know, they are a well-respected manufacturer, and they have a lot of professionals that use this particular brand. But they are still, you know, a relatively small business. Pickleball is a up-and-coming sport, but obviously doesn't have the market share of a tennis company or something. In any event, they sent this email out this morning and said, hey, we are going to do everything in our power to keep your pricing of our paddles reasonable. We are a small business who we've painstakingly labored over creating supply chains for the last decade so we could get the best components to make the highest quality product in the game, and keep the price reasonable enough that consumers can still afford to play. I mean, these aren't cheap paddles. You're spending $250 on a good paddle of this particular brand. And they said, but with the current tariff policy, most of our vendors have increased prices to these components that we're purchasing by well over 150%. So for us to be able to navigate this, one of two things is going to happen. Either our paddles are going to become priced out of the market, or we're going to have to hang up shop and call it a day. And they said, we're going to do our best to be with you guys for years to come, but we just don't know how this is going to play out with vendors changing their pricing. Pretty scary.
Yeah. And the concern is, you know, a company like Apple has the resources, though unpleasant and impactful to earnings, you know, they'll still be a viable entity regardless of what happens. For, you know, these smaller entities, you know, that can be, you know, rough.
Very disruptive.
Yep.
So tell me a little bit about this chart here.
Yeah, so we wanted to highlight some of the asset classes that have actually been weathering the storm fairly well. To be clear, it's been a broad sell-off, and nearly every asset class has sold off to some degree or another. But I wanted to call out just a few things that have actually been either treading water or even going up a little bit as we've been going through this. So the top line you're seeing there is gold. Gold has weathered the storm fairly well with kind of a flight to safety, and particularly with some of the concerns that we've had around kind of U.S. Treasury markets, the value of the U.S. dollar, et cetera. Gold has actually done fairly well. The other two charts are bonds, both short-term U.S. Treasury bonds and corporate bonds. They've done a good job of preserving capital throughout all of this. One that's not on there is insurance products like annuity contracts. That's another stable value type thing. And a lot of our clients hold these types of assets in various forms. And this is something that has helped provide quite a bit of ballast to the portfolio. Equities, to be clear, have sold off, but having some of these assets in your portfolio has been helpful.
Yeah, for sure, for sure. Well, let's shift gears just a little bit, Scott. I want to talk about the importance of in the face of all of this uncertainty, remaining true to the best practices of retirement planning. And you talked about, certain products having weathered this better than others, and having some of these investments just flat out sold off. And that's frustrating. And I think there's a temptation when we experience some of the emotion of this current situation to say, I don't have time to make up these big losses. We need to get out while we can. Kind of harkening back to the story we talked about with Home Depot, where it's like, does this mean it's just gone, right? Or will I not be around for it to come back? And I think it's important that we kind of zoom out and remain objective. And people literally hire us to help them get through these tough times. That's why we have a career. And one of the things that good leadership requires is maintaining a level head in the face of chaos. And so we don't do it because it's, some kind of repeating self-affirmations in the mirror in hopes that everything works out okay. We do it because it literally is the best practice scientifically.
Yep.
Objectively, scientifically, these are the best practices to get us through the hard times. We're not just crossing our fingers and hoping. We're saying, no, this is the best practice. So this chart here shows that if we had studied the 25-year study of $100,000 invested and remained fully invested, this is the S&P 500 for those 25 years, the annualized return would be 12.34% per year for 25 years. But if we eliminate just the 10 best trading days during that time frame, we would lose over 4% of the annualized return per year just by taking away the 10 best trading days. If we go all the way to the bottom of the chart and remove the 60 best trading days, those 25 years are negative. We would have lost nearly 3% per year for 25 years to eliminate the 60 best trading days. So now something everybody's going to say next is, yeah, but just eliminate the worst trading days, not the best trading days. So let's talk about that. The worst trading days, we talk about some of these really impactful moments where we remember the crisis, right? We talk about COVID-19. We talk about the financial crisis of the housing market. We talk about the tech wreck of the dot-com bubble. If we go and kind of take these and we kind of organize and categorize them, the best trading days, in this case, the 30 best trading days since 1997, all of these 30 best trading days took place right in the midst of these crises.
Yeah. No, these are fascinating concepts. And on the previous slide, think about, this. Typically, there's about 250 trading days in a day. If you're talking 25 years, that's 6,250 trading days or something. So if you had been in the market for 6,240 of those, you wouldn't do nearly as well if you'd been in the market only 10 days more.
Right.
And that's why, advisors, have, some of these mantras and ideas of staying invested and staying in the market. Because to your point, this isn't just a affirmation. This is scientifically based data. And that's not to say you don't want a diversified portfolio. That's not to say there are some behavioral things we need to look into where we might need to, like we talked about in our last Market Minute, let a little bit of air out of the tires so that you can hang on to your investments. But these are powerful principles for us as investors. And just another, thought as we've been talking about this, Paul. I worked for a UBS, huge Swiss bank, years ago, early in my career, and Art Cashin was a legend there. He was the director of floor operations, and he had something that he'd say, during the financial crisis and other periods of market turmoil, and it was this: the end of the world only comes once, and I don't think this is it.
Yeah.
And so it can be scary when we have some of these things that are unprecedented and unknowable. The temptation is, hey, this is so different this time that stocks are never going to come back. Rest assured, stocks will come back. We don't know if it's today, tomorrow, next week, next month, but markets always recover.
Yeah. Yeah. You don't want to bet on the end of the world.
Right.
Right. Because it's just going to be a one-time event. And if you're wrong when you make that bet, you're going to lean into that crisis. It's going to dissipate. You're going to wake up off sides. If you're right, we're all in the same place anyway. We're all ending up in the same place anyway. So to just finish this thought here, why we don't want to sell. This was the same chart you showed us a moment ago, broken down last week by day. So we had the what was this, the third. We lost nearly 6% in the NASDAQ. The fourth, we lost another nearly 6% in the NASDAQ. This was the seventh, I think. We lost another 2% in the NASDAQ. It would have been perfectly reasonable to hit your breaking point.
Yeah, we've lost 12% in, just a few days. Yeah.
I mean, it would have been perfectly reasonable to say, this is it. And to say, I emotionally cannot cope with it any longer, and I need to pull the fire alarm. The issue is, if that had been what you had done, then you would have missed out on the very next day where the market grew back that 12%, right? So you would have locked in that 12% loss, and then you wouldn't have been able to recoup its entirety in one single trading day. This is the point we were making about the best trading days tend to happen right in the midst of the chaos. So it's not a good practice to get caught up emotionally in that storm, lose sight of good leadership, best practices, and then find yourself significantly in a world of hurt. So, Scott, one thing that we're very, very mindful of as advisors is this is live bullets, and our clients are, this is their retirement. And this is what's going to determine their ability to maintain their quality of life, their standard of living. It's going to determine their ability to be present with their families and generous in their endeavors. And they don't have the luxury of being able to put this in significant amounts of risk. And so we talk about the term unnecessary risk, and we are all in favor of eliminating entirely any unnecessary risk. That's why we lean so heavily into the concept of smart retirement, where we bucket our investing, right? We've got gray buckets, green buckets, yellow buckets, and red buckets. And not everything is going to be exposed to this conversation that we had. In fact, the only bucket that really is truly exposed to this conversation is the red bucket. And when we appropriately lean into smart retirement and build a bucketed approach, our clients have the ability to take out distributions during moments that matter in retirement, for a trip to Hawaii or a new car or a remodel of a kitchen, without the stress, fear, and anxiety of having to time the market around these exact moments of chaos.
Yeah. One of the ways I like to frame it for our clients is some of the dollars in your portfolio today you will not touch during your lifetime. And so if you have $1 in your portfolio that you're not going to touch during your lifetime, why not have that money in something that's going to give you the very best growth opportunity over time? Conversely, you're going to have some of those dollars in your portfolio that you're going to need in the here and now, and let's make sure that those dollars needed in the here and now have a level of protection and safety with them.
Yeah. And even that dollar that you're not going to necessarily need for your lifetime, we're talking about getting the best return. We're not talking about gambling it and putting it into something speculative. We're talking about buying real assets that will be there for you to hedge against the other risks that you're exposed to, like inflationary pressures that are chiseling away at your purchasing power. You know, when you own good quality assets that can help hedge that inflationary pressure, it's just good planning. Yeah. So I think, Scott, that's the good spot to wrap up today's episode of the Market Minute. Let's remember to stay smart in our retirement journey. We want to know where we're headed. We want to have a plan. We want to stay steady at the helm. And we want to travel with a trusted team that has gone down this terrain before. So thanks, everybody, for trusting in us. Until next time.